Mihir Worah, Deputy Chief Investment Officer with PIMCO, talks about why India remains a favored EM market for foreign institutional investor from a long-term perspective, and the favorable policy reforms is something which Mr. Worah is confident of. Worah also analyzes the key takeaway of Budget 2014 and makes the case for investing in Indian bond markets as well. Here's an excerpt of that exclusive conversation with Tanvir.
So there has been a cool off, whether you look at the CPI or the WPI, and I think that's fundamental. You will get, and and India does need to mature its agricultural sector, so you don't get these bouts of inflation that are dependent on the weather, but you're getting reforms on the fiscal side, and obviously you've got a new central bank governor who is who's not going to make the same typical undisciplined emerging market mistakes of the past. So I think as far as inflation is concerned in India, I think it's on a much better trajectory than it's been any time in the last 10 years. Inflation's come down, and again, there could be weather-related spikes, but fundamentally, inflation in India over the next 10 years is going to average probably less than it averaged over the last 10 years.
In that light then, talking about the government benchmark bond, do you think at 8.5% yield, that's an attractive investment opportunity now that the expectation of a rate cut is perhaps back on the table with the latest inflation numbers?
I think Indian bonds are attractive from a fundamental credit perspective, from an inflation perspective. In fact, I think the government bond, the nominal government bond is attractive to neutral, and the sector that I specialize in, those Indian inflation-linked bonds, I think are a screaming buy. Unfortunately, institutions like mine, the regulations are so onerous that we can't buy Indian bonds, but as much as we'd like. But if I could, I think those Indian inflation-linked bonds are a screaming buy.
Right, and talking about inflation index bonds, because while you find them very attractive in India, we haven't found many takers for that instrument. How does one look at hedging inflation risk then, and what's the opportunity that you see in the India dedicated inflation index bonds?
I think again, I'm not the expert. I follow those for three reasons. One is I follow everything that goes on in global financial markets. B, my history is a deep specialization in inflation bonds, and C, I'm Indian, so I follow those. But they came at the wrong price when they were issued at a yield of inflation plus 1.5%. That was too rich. I wouldn't buy them even if I could. And so when things get placed at the wrong price, too rich, and then they sell off to correct prices, I think it burns and scars a lot of the original investors, and the whole asset class gets a bad name. Currently, they're trading at offering something like WPI inflation plus 4.5%. I think that's very attractive, and people who can get their hands on them should.
So, since we have you with us and you're talking about India, how can I not ask you about what you felt about the Indian budget? Do you think the government in its maiden budget pretty much delivered on expectations? What was your overall view?
So on the budget, I think the budget was. Some folks say they were a little bit disappointed in the budget. I don't think so, because I happen to be pretty patient both in my investing and personal life. I think it had some of the steps in the right direction. In particular, as it pertains to the railway budget. So I don't think you need a big bang, flashy budget that can't be followed up, but I think it's a step in the right direction. And what's going to be important is to see that the budget is being implemented and other reforms that are needed are also being steadily implemented. So I thought it was okay.
Let's talk about your overall view on emerging markets. And, in one of your recent articles, you have stated that this is a good time to actually increase allocations to EMs, given the valuation gap between EMs and developed markets. What kind of upside do you expect from emerging markets then in the second half of this calendar year, over the next 6 months, that is?
I am seeing the trend pick up in that direction. Emerging markets, after lagging developed markets miserably in 2013, on average in 2014, they're slightly outpacing developed markets. Emerging markets as a whole are up about 6% in 2014. India is obviously up much more, close to 20%, but emerging markets are up close to 6%. And I think, the valuation gap has been around, and part of that valuation gap has been justified because earnings have been dropping in the emerging markets, and the growth differentials, the fact that the emerging markets used to grow so much faster than the developed markets, those growth differentials have come down too. And then obviously last year you were hit by really bad technicals with the taper tantrum and expectations of, an abrupt withdrawal of liquidity. I think all of those factors are turning around. Earnings, return on equity and earnings revisions are moving up rather than moving down. The fears of a hard landing in China are turning out to be overblown. It is a slowdown, but you're getting some policy easing measures in China. The fears of an abrupt liquidity withdrawal, and in particular, what we call the new neutral, this expectation that the long-term real interest rates in the United States are actually going to be lower than what people expected. Like I said, turns around the technical picture or the liquidity picture that was hurting emerging markets, and I thought that the valuation gap, for a long-term investor, earlier this year was the time to start investing. And I think from what I hear, the emerging markets have been seeing steady foreign inflows, and expect that to continue. As far as the rest of this year, emerging market equities are up, like I said, 5 to 6% in the first half of the year. I'd expect another 5 to 6% gains in the second half.
Well, India has been an exception to that rule, clearly, with the 20% year-to-date return. And that brings me to my next question, which is which are the specific markets where allocations could increase, and could India, given its run so far into the year, still be a candidate where there could be more money incrementally allocated?
I think you've got to be incrementally, given the long-term story on growth going up, inflation coming down, earnings generally, return on equity and earnings generally moving higher. I think as a long-term investor, you've got to slowly increase your allocation to India. But I agree. Given the 20% rally year to date, you don't want to jump in right now, but it's definitely an attractive destination for long-term investors.
Then what would be your specific view on EM currencies? Actually, specifically, if you hold a view on the Indian rupee.
I think we're positive on the rupee. We've touched upon many of the reasons. It's the current account closing, the RBI being much more careful. They've been building up reserves over the last several months, smoothing out the volatility, so you get high carry, low volatility, a positive growth story. So definitely, positive on the rupee, positive on other high quality, high carry, low vol emerging market currencies like the BRL and the MXN, and generally, bearish on some of the European emerging markets like Hungary in particular.
I also wanted to ask you about, the risk of potential deflation coming in from China. The low inflation prints in China are raising hopes of more stimulus. What does that mean for the liquidity risk premium going forward, as US QE will, it seems, get replaced by QE from Europe, China, and Japan? Right.
So I think we're in a sanguine period for liquidity and for equities. Like we said, emerging market equities another 5 to 6%, developed market equities less. But you're correct. The Bank of Japan, the ECB, the Bank of China are going to continue to pump liquidity in the markets, and the U.S. Fed, while it tapers and it's going to stop buying bonds and stop pumping money into the market in October, its policy rate is still running loose monetary policy that's somewhat lower than the market needs in an effort to get inflation higher and the unemployment rate lower.
Hmm.